All right, let's come back to the story that we've been watching closely in these markets, namely, we're calling it the Reddit trade, for lack of a better term, but certainly the focus on huge short positions that are in certain stocks and the decision to then go long those stocks to force those who are short to cover, squeezing them ever higher. This continues this morning in a crazy way. Bob Pisani, I want to bring you in. But, you know, I wonder as well, as we watch an S&P now that's down 2%, and as I continue to hear from people that I'm speaking to of hedge funds that are under a great deal of pressure as a result of being short some of these names, and there are a lot of them now, and having to potentially sell their longs. I don't know to what extent, Bob, you think this is having an impact on the broader market, but it's not too hard to imagine that might not be the case.
Yeah, certainly hedge funds have positions. They're not just short stocks. They're long a book and they're short a book. And when you get the positions out of whack here, they have to maintain certain levels of longs and shorts, and they have to adjust their portfolios, and that can have ripple effects on the market. So, yes, I think it does. I think there's some broader things going on here that's not just that related. I think there's obviously some concerns. Earnings are good. If you look at Microsoft, it's not going to get any better than Microsoft. Their numbers were just simply fantastic across the board, yet it's up only 1% because it's moved up huge going into earnings. So we've got a problem here with stocks moving up in expectations of great earnings, and we're getting them, so it's hard to move the market forward. I think there's a little bit of that as well. As for the short story, and there you see Microsoft down here today. But remember, 117, a week ago in anticipation of earnings? It goes to 132 a few days ago, and now it's up there. So here's those heavily shorted stocks. And, of course, as David mentioned, it's not just GameStop. We were talking all yesterday about all these names, including Tanger Factory Outlet and iRobot and companies like that. I think here's the question. What's different from the 1990s chat rooms? We spent a lot of time, David and I, in the chat rooms in the 1990s watching that. And there are some things that are very different from the 1990s. The information flow is very different. The ease with which you get information and get access to it, including on your cell phone, is different. The zero commissions are certainly different and may be a factor. The overall gamification of trading is different. That you can trade stocks like you do sports betting, which also didn't exist to this extent in the 1990s. You have to know that there's a difference. But then there's things that are not different, and I think that's very important to point out. The old-fashioned sense of greed, the whole herd behavior. There was a whole group of behavioral economics terms we all had to learn after the dot-com crash. We all got very familiar with concepts like herd behavior, which is the idea that we're all just going to move together. Confirmation bias, that investors kind of believe what they want to believe, what their biases want them to believe, and they just look for reasons to confirm that. The gambler's fallacies, that a series of wins are going to go on forever somehow, and you're never going to lose. And finally, loss aversion, something we all became familiar with, which is that the great weight of concern for losses, the concern for the weight of losses is much greater than from market gains. And we'll see if loss aversion becomes an issue in this story. It could well be. I think, David, the question here is there something really different here?
Well, yeah, it's kind of different. It's kind of different, Bob. No, I mean, in the sense of, yeah. You referenced that period of time that we all remember quite well, and we've made certainly allusions to the late 90s. But I don't quite recall the focus on companies that had large short positions, certainly not larger cap companies that we're seeing now. I mean, you had a lot of small caps that moved. Typically, it was just on the buy side. I'm not quite sure we've seen anything quite like this. And by the way, the sums of money here are fairly significant. I mean, we talk about retail, but there's some people stepping up for some large options purchases here who have to put up a decent amount of capital to do that. Not to mention, I mean, somebody buying the 200 calls yesterday on GameStop that I guess were listed and now has made a fortune on them. There are things here that are unique.
Yes. The 1-2 punch of the ocean of liquidity provided by the Federal Reserve combined with that gamification of trading, combined with this strategy of buying out-of-the-money calls, has proven very effective. I'm talking about a broader philosophical issue, David.
Yeah.
I'm talking about the idea, which is, if you want to believe that GameStop's going to be $200 6 months from now, you have to basically believe that fundamental analysis doesn't really matter, that even technical analysis may not matter. Do you really believe that? So fundamental analysis based on the idea that there's an intrinsic value in the stock. And of course, as of now, this doesn't matter at all. Now, we know that this can not matter for short periods of time. I think it's highly debatable about whether suddenly we have discovered a new analysis, not fundamental, not technical, not quantitative, flow analysis, whatever you want to call it, Carl. Is there some new analysis that suddenly has come out of nowhere, that we have discovered some new principle, that the forces of gravity have been repealed upon us? I don't think so. I doubt that. I think it's wonderful that people are participating in the market that haven't before, David, but you know what I'm getting at.
No, I do, but there's going to be a lot of hedge fund executives who are going to need traditional analysis, Carl, after this is all said and done.
Shepard Smith here. Thanks for watching CNBC on YouTube.